Welcome to The Explainer. Today, we're putting on our hats as investigative journalists of financial statements. We're stepping completely away from the mainstream financial news hype, the flashy headlines, and the standard talking points. Instead, we are tearing down the narrative around American Waterworks, ticker symbol AWK, to find its true intrinsic value. We're going to be objective, data-driven, and highly analytical.
Here's our syllabus for today's masterclass. First, establishing our disclaimer and baseline. Second, the ultimate valuation gauntlet. Third, uncovering media blackout flags. Fourth, a reality check by investing legends. And finally, its economic moat and our final verdict. Let's dive right in.
Section 1, Disclaimer and Baseline. Let's quickly establish the ground rules before we put American Waterworks through the gauntlet. To be clear right out of the gate, disclaimer, this is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. All right, our baseline today is 136.66. That is the current market price of AWK as we run this analysis. This is the number the market has assigned, and it's the exact hurdle we are going to test against our barrage of strict intrinsic value calculations. Section 2, the ultimate valuation gauntlet. We are now hammering this stock through 21 distinct financial models, grouped logically to see where the math truly points. Let's kick things off with Group A, our cash flow models. A standard discounted cash flow yields an intrinsic value of $110, but when we adjust for things like heavy debt and massive capital expenditures, the numbers drop. Unlevered free cash flow sits at 105, and free cash flow to the firm drops to 102 because of that heavy debt drag. And free cash flow to equity, which is what you and I as shareholders actually care about, plummets to just $95. Even adding in significant tax shields with the adjusted present value model only gets us to $115. The crucial takeaway here, massive capital expenditures are severely dragging down cash flow valuations well below where the stock trades today. Moving on to Group B, the dividend and income models. Now, AWK looks a bit better here. A standard dividend discount model gives us $125, and a Gordon growth model hits $130. A multi-stage model actually beats the current price, coming in at $140 by factoring in high initial growth. But then we hit our reality checks. A residual income model drops to $85, and economic value added, or EVA, comes in at a harsh $90. Why the massive drop? Because EVA reveals the massive capital charge, essentially the structural cost of holding on to their $36 billion in physical assets. What does this mean for your portfolio? It means our dividend growth is fighting against a very, very expensive balance sheet. Next up is Group C, the comparables. Comparing AWK to sector peers suggests a value of $135, right in line with today's price. Precedent transactions push it to $145 if we factor in historical acquisition premiums. However, strict trailing price-to-earnings and price-to-book metrics pull it back down into the 117 to 132 range. Even looking at enterprise value to EBITDA at 128 or EV to sales at 120, the story is pretty consistent. In short, compared to its utility peers, AWK is trading right at or just slightly above fair value. Finally, Groups D and E, balance sheet and advanced models. These numbers really highlight the wild extremes of utility valuation. Pure book value directly from the balance sheet is just $58.70 per share. Net asset value sits at $65. A fire sale liquidation value? About $40. I mean, you can't exactly dig up and easily sell used water pipes, right? But check out the replacement cost. To rebuild their 55,000 miles of water mains today would cost roughly $180 per share. And if we run a real options valuation using Black-Scholes logic for their future expansions, we hit $150. There's just a massive, massive gap between what the company owns on paper and what it would actually cost to replicate its infrastructure today.
Section 3, the media blackout flags. Time for some true forensic accounting. We're digging into the footnotes to uncover what the mainstream financial media completely ignores.
Let's uncover the 7 red flags. First, a massive negative free cash flow of $1.14 billion. Media completely ignores this because they're too busy cheering a Q2 EPS beat. Second, 22% non-revenue water leakage. Mainstream outlets just overlook the 93 billion gallons lost annually to leaks. Third, rising total debt hitting $16.06 billion, entirely overshadowed by the quote-unquote stable utility narrative. Fourth, Capital expenditures are vastly outstripping operating cash flow, $3.56 billion in capex versus $2.33 billion in cash flow. But that cash burn is just too complex for a snappy TV soundbite. Combine that with negative working capital, rising depreciation quietly buried in reconciliation tables, and a high PE ratio of 24. Retail investors are blindly chasing a 2.6% dividend yield while totally ignoring these structural cracks. Let's just pause on that second flag for a second. That 22% non-revenue water metric isn't some quirky accounting adjustment. It is a literal physical leak in their system. They are pumping and treating millions of gallons of water that never generates a single dime of revenue, directly eating into their operating margins. It's absolutely crucial to understand. But look, as analysts, we have to stay objective. It isn't all doom and gloom. Here are 7 green flags the media also misses. First, $216 million in secured rate increases for 2026, often buried deep in regulatory filings, not press releases. Second, a massive $234 million cash injection from PFAS legal settlements, which protects their future capital structure. Add in a solid 8.44% 5-year dividend growth rate that easily beats basic inflation, and a highly sustainable 58.3% payout ratio that's just too boring for media hype. Plus, you've got the looming essential utilities merger, flat operation and maintenance expenses proving hidden operational efficiency, and a 100% regulated earnings profile that provides a bulletproof revenue moat during market volatility that the bears completely miss. Section 4. Legendary Investors Reality Check. The math is definitely conflicting, so we're bringing in the investing greats to judge AWK's current metrics. Would Ben Graham, Peter Lynch, or Warren Buffett buy this stock today at $136.66? The verdict from the legends is pretty brutal. Ben Graham demands a PE under 15, and his Graham number formula gives us an $87 valuation. With AWK trading at a PE of 24 and the price far exceeding its net current asset value, Graham gives it a hard fail. What about Peter Lynch? He calculates the PEG ratio, comparing price to earnings relative to growth. Lynch's formula dictates fair value should sit around a 10.6 PE. With AWK at 24, Lynch also says fail. Finally, Warren Buffett. He looks for true owner's earnings and a solid return on invested capital. Now, while Buffett loves a wide monopoly moat, AWK's massive debt-to-equity ratio of 1.38 and relentless maintenance capex utterly wipe out the cash owners can actually keep. So Buffett says, fail too. Section 5, Moat Analysis and Final Verdict. Time to synthesize all this data. We're combining the 21 financial models, the 14 forensic flags, and the Legends criteria into a definitive 3-paragraph summary. First up, let's talk about the economic moat. Morningstar defines moats by 5 sources: intangibles, switching costs, network effect, cost advantage, and efficient scale. AWK undeniably possesses a wide moat. This is driven heavily by efficient scale, meaning it would be absolutely financially ruinous for a competitor to lay down a duplicate set of 55,000 miles of pipes. Plus, they have massive regulatory intangibles, essentially operating as state-sanctioned monopolies. So here is paragraph 1 of our verdict. Valuation. When we strictly average out the gauntlet of all 21 intrinsic value models, the result is approximately $118 per share. Therefore, based purely on the math, American Water Works is currently overvalued at its market price of $136.66. It is priced for absolute perfection right now, despite carrying massive cash burn and capital requirements. Moat trajectory. Despite that steep valuation premium, AWK's economic moat is not shrinking. It is actively expanding over the next 3 years. The pending essential utilities merger, combined with their ongoing success in securing over $200 million in rate-based increases, continues to solidify their unshakable grip on the markets they serve. And paragraph 3, our final takeaway. The pure quantitative models and legendary investors are pointing aggressively one way, towards overvaluation and real cash flow concerns. Yet, those hidden green flags and an ever-expanding regulatory moat suggest this is a bulletproof fortress asset that might just command that premium. So which side are you on, the strict math or the unbreakable moat? As always, do your own homework. Thank you for joining this explainer.